Master Trader Live, simple market analysis and education to help you make money in the markets. Join us live each week on YouTube and see past episodes at Master Trader Live. And now your show hosts, Greg Capra and Dan Gibby.
Hey, everybody. I was trying to press the button to turn on the webcam there. I got it. So today we're going to be talking about option strategies to unlock your financial edge. Well, we're always looking for some kind of edge in the market, which always starts with a price pattern. And so there are many option traders out there that don't look at charts. To us, that's like the proverbial going to a gunfight with a knife, right? Probably a butter knife. Not that some of them don't do it well, but if you have something to use to your advantage to put that edge in your favor, we think it's foolish not to do it. So, looking at price patterns where, you can sell an option, which is going to be today's primary focus, selling options around price patterns, either to, always to put money in your pocket, right? Lower your cost, speculative as to buying cheaper, if possible, if prices should go there, or just putting, again, some more money in your pocket in different ways. I think you'll find today, of course, educational things that you could utilize going forward for your own strategies, which is always the goal of Master Trader Live. So option trading, I know it was for me, and I think for most people, can be a little bit of a struggle at the beginning to get your head wrapped around different terminology and understanding things. We focus on simplifying things as much as possible, but if some of the terms are new to you, don't be afraid to ask questions. We're happy to answer. And don't feel, like you can't do this. You can. Just take it slow. Again, learning the terms and getting your head to assimilate this. I'm just giving you a little heads up, because as to getting into certain new things, especially like options, can be a little bit of a struggle, but we all get through it. So let's do it, Dan.
Hey, good afternoon, everyone. Yeah, so Greg, maybe a different way of trying to summarize what you're saying also is options are a derivative. That sounds like an important, difficult term, but it's not. It just means it's something derived from something else. So you could trade a stock or an ETF or a cryptocurrency. You can buy or sell it. And the beautiful thing about options is, hey, it's just this other way through call and put options that are allowing us to engage in this same business of having a bias on the stock, ETF, crypto, whatever that moves, futures. And we're just doing it through these other instruments. So that's why it's called a derivative. And the benefits of these derivatives are they're three-dimensional. Instead of just buying or selling something, then, as you're going to learn today, we can combine strategies that give us a higher probability of profit than just trading the underlying alone. So yeah, you got to get used to the terminology of what these derivatives are. But they're three-dimensional and give us many more trading opportunities for different biases on the underlying. And you'll see today when we're talking about selling these options for these bullish patterns. Again, it's improving our edge that doesn't exist with buying the underlying. So yeah, let's plow into it here. Here's our intro slide that we always show for obvious reasons. This is our technical approach to trading anything that moves. We're price-based patterns. traders, we need a compelling setup. Price void means for longs, there's insignificant resistance to the left and it has room to move. Now, this is the same approach that we're going to use to trade stocks or options. Just the options is a derivative. So it's just a different way to trade our same technical approach. So this is a starting point. That's why, I get dozens of emails every day of, damn, what option course could I take? I love this stuff. I saw your seminar. I want to buy them. I want to sell them. And I bring them back to Greg's course. I say, which is Greg's swing trading course, which covers all this and, in great detail. I say, you need to understand price action because that's our edge. In fact, my friends over at Tasty Trade, I love them, but we disagree on our technical approach. They think people can't read charts. They just trade off the numbers. And guess what? We have 85% batting average. And if charts didn't work, then you wouldn't be able to flip a coin and have any greater success. And, we've been at this 30 years, and that's just an incorrect statement. All right, just the definitions here today, and that there's all kinds of option trading strategies. Today, we're going to focus on, look, I want to buy a stock and improve the probability of profit through a covered call, or I'm going to sell a put because I don't mind owning the thing. That's going to be our focus today. So today is not buying call options as a derivative to taking a bullish bias on something. But, just start it with the basics. What's an option? Again, it's this derivative. So it's a contract. We go to the option table and I'm going to buy a call option. I'm paying money and it's giving me the right to buy the underlying. So that's why it's a derivative. I'm buying this cheap option. As the underlying goes up, the call option is going to go up. Now, today, we're going to be talking about selling options, but it's not naked. We're going to be selling these options around buying the stock, and that's what's called a covered call. Why on earth would we do that? Well, because we're receiving money, lowering our cost basis, and improving our probability of profit. It'll become crystal clear when we look at examples. Now, this is actually has a similar reward to risk ratio. So instead of saying, hey, I want to do a covered call on Apple, well, sell a naked put on Apple. What does that all mean? Well, when we sell a put, we're taking in money, and we have an obligation to buy the underlying stock, Apple, on or before the expiration at whatever agreed strike price you sold that put on the option table. Okay, that's as simple as it can be. But by doing this, if we do have to buy Apple, which we don't mind doing, our cost basis is significantly less than if I were just to buy Apple right now at $222. Again, let's go to the examples, but these are the definitions for you. Greg put together this slide. I don't know how many years ago, Greg. You have so many timeless slides, which we repeat in selective context because they're priceless.
The whole method is timeless and applicable to everything, which reinforces the fact that it's the truth. Because whatever you apply it to, it's going to guide you as to Is it a pattern? Is it going up? Is it going down? Is it going sideways? It's not. As it relates to options, our method, unlike the indicator-based methodology, is not a derivative of the underlying, which is the indicators are, are that. And, when I hear terms like, oh, this indicator anticipates what the prices are going to doing, it's just ridiculous, so.
So look, this is our starting point. These are 9 bullish setups. And then you go back to the other slide and say, okay, well, I don't know what time frame this is. I don't know what instrument it is. It doesn't matter. We start with a compelling pattern on the time frame you're trading, and then those other concepts. Where is it in the trend, support and resistance, relative strength, weakness, multiple time frames, what are the broader markets doing? But we're doing the same thing in trading options. Let's continue. What is a covered call now? Well, let's start with buying stock. You buy stock, you just buy however many shares you want. End of story. You're going to profit if it goes up, you're going to lose if it goes down. A covered call, if we do this at the outset, you put your order in with your broker. I'm going to buy Apple stock. I'm looking at the quote right now, $222. And I'm going to short a call option on Apple to take in money. And I'm giving somebody the right to buy my Apple stock from me. Why would I do that? If I'm bullish on Apple, why do I want somebody to have the right to take my merchandise? Well, that's exactly why I call it a mildly bullish directional trade. If you're fully bullish, if you will, then you just buy stock or you buy a call option. Okay, so by selling a call at the same time that I'm buying stock, I call it a mildly bullish directional trade. But here, the higher probability of profit. Why is that by definition? Well, I could look at a quote screen, but I'm not going to do it right now. Let's say I take in $3 for selling this call option on Apple at the same time I'm buying it. Well, guess what? My $222 cost of Apple just dropped to $219. So my cost basis is lower than yours. That's why it improves the prior probability of profit. But I'm capping my gains. That's the trade-off. And I'll show you a chart here, time permitting, but we prefer legging into a covered call. Just in your head, imagine this. Okay, so you buy Apple at 222, it rallies $5, stalls. Now I sell that out of the money call option. But again, let's look at some pictures better. All right, so some of many of these are old charts, but it does not matter. It's identical. So, Greg.
Yes, sir.
Here's a chart. We start with the charts. Came down hard, breakdown failure, back up, going sideways, wide range breakout. Now, we could, so we have to start with, Greg, is this a fully bullish setup or a mildly bullish one?
Well, I would kind of in between,
Agreed.
mildly bullish.
Right. So that's why in this example, we're going to buy a covered call as an opening trade, as opposed to legging into it later to reduce cost basis. Okay, what are you going to pay me to do this? Let's look at the math here. So I buy and just use this closing price. So I'm buying the stock at 132. So we go to, this is an option table, call options, out of the money, which means they're higher up, 25 days to expiration. So look, I started with 132 right here. So Greg, let me ask you this question, and obviously that means to everybody else also. Would you rather just buy the stock alone at a 132 and swing trade it, which there's nothing wrong with that, or buy the stock at 132 and give somebody the right to take our merchandise from us at $145? And I just use the midpoint here, just again for conversation. We are taking in $3.15 a share, which is a reduction of our 132. And if somebody wants to take it at 145, have at it. If assigned at 145, then I made almost $10 a share, 7.5% return.
Everybody follow that? I ask because
Try
it
to
is
make it simple
pretty
as
much, okay, so Raul, look, what he's saying is, here's a pattern. This week, you can call it a head and shoulders, you call it a downside shakeout, whatever. It went down and it sprung back up again. And this is the bullish price action at resistance. For those that are familiar with how we look at things, wide range bar, kind of it's a 1, 2, 3 little combo stuff. So now he's saying, okay, let's buy the stock at 132. Sell this call option down here. It was a 145 strike, the midpoint. I was drawing while he was talking, $3.15. So you put the $3.15 in your pocket, 1,000 shares, $315. Right?
well,
So you've
right.
lowered your cost by the $3. So now your cost is not 132, it's 129 and change. And you've sold the right for someone to take your stock at 145. Assuming all that works out, like every trade that we place, we assume it's going to work out the way we want. And this goes up. They're going to take that stock at 145. And so if it does nothing, where is the time to expiration? 25 days, time to expiration. Let's say that 25 days passes and the stock is at 140. You still get to keep the stock. If the stock goes to 150, they take your stock at 145. You're a happy camper. You made your money. You knew what you were doing from the get-go. And you might say, oh, if I didn't sell that, I would have made that extra, whatever. But in reality, what you didn't make was the difference was $2 because you lowered your cost. Right? You didn't buy it at 132. You sold the call option. Your cost is 129 and change. And so if it was at 150, if it went, say there was like today, the news, and it opens up at 173, you're going to be like, oh, Dan, why did we do that? But you see, that's the unknown. Thing is to understand the strategy.
Greg, I have one more scenario that's very important. What will happen in 25 days to expiration if just magically it closes at the identical 132.09? What is the difference between the long stock buyer and us?
You made $3.
Exactly. See, the stock can chop around and do nothing. In a covered call, we're still making the time decay day by day. So again, that's why we call it a mildly one. It's a beautiful trade-off that does not exist in just buying stock. And you have to decide based on the pattern and the premium that you take in. And we get it into all this in the full options course. Is it worth the trade-off of lowering your cost basis versus capping your gain? And that's
Dan, one second, Dan. So how much is the minimum amount to start trading options? Well, you couldn't do a covered call option strategy because you have to own the stock. But you could buy a call, you could buy a put. What would you say, Dan? Generally, like 5 grand?
uh, yeah. Minimum account size, I say, yeah.
You know, you, you can't sell naked, but you could buy puts and calls. So if the call option's $3, it's $3 for a one contract.
Yeah. So again, we get into this in great detail in the option courses, how, which one of these strikes, how many days. I mean, look, we're already spending 22 minutes in today's session, but as always, we give you as much as we can. Our sweet spot on these is 7 to 30 days. I'm going to show you an example here where it's just, you can routinely do this. Now, what I'm showing you here is, let's say you started with just buying the stock or just buying the call option because it was a fully bullish setup. These are all just pictures of when momentum stalls and you don't think the stock's going to go up much more. Now go to the option table and figure out if you're getting good premium for selling an out of the money call option. Here's an example. Let's say we bought the stock right here because this one's fully bullish. You see how this one's different than the other one? So now it's rallied, far from the 20. Now, there's nothing wrong with just selling your stock and get the heck out of Dodge. So you only leg into a covered call if you still want to keep the underlying. And this allows you, Greg, how do you say it? It allows you to mentally sit through pullbacks with more ease. You said something like that one day.
Well, it's all, up to the individual, but, you sell the covered call, you kind of feel like, okay, if it does pull back, it's like a double-edged sword, you know, if it pulls back, you feel good because you lowered your cost. If it goes higher and they take your stock away, you're like, oh, woulda, coulda, shoulda. So you do the best you can. And this is where the chart really helps because visually we can see that, whatever this stock is, it went from 47 to 52-ish in a very short period of time. And again, technically, you understand these concepts that this vertical move, there's a difference between one stock going from 47 to 32 and this one, because this one went vertically, whereas if another one was chopping sideways and up and it kind of like plodded along at a slower pace, it would not be as attractive to sell that covered call. And in addition, well, this created what we call a void because it moved up vertically, okay? And it opens up the door to a retracement or at least chopping around a little while. That's the belief of the pattern.
Mhm.
And so getting extended like that, and then you want to look at, the time to expiration. I assume that's on here. Right. So if, whatever it is that 8 days, Dan? Is that what that says?
Yep.
Okay, 8 days to expiration. So the strategy here is, okay, let's see what the strike, $52. It's at $52.
Yep.
So you got to be sharp with this one because look, the risk here is that you make less money. Right? So it's like not like you're going to lose because it goes up and they take the stock away. If you're going to get your $52 and you sold that option for whatever it is here, $1, let's just call it $1.72.
Well, Greg, yeah, look right here. So this is a real trade. We send by telegram alerts. We bought the stock here, you know,
Okay.
and selling the July $52 calls for, oh, that's totally wrong. That's a typo. That should be a
Good.
$1.62.
Correct.
That's a typo, $1.62.
Yeah. Yeah. So yeah, I mean, I'm looking at the bid and the ask here. It can't be that. So it's somewhere in here, whatever that midpoint is that you're going to get filled,
Right,
that
right.
you're going to lower your cost. So if it pulls back, say it pulls back to $50, you still lowered your cost by $1.62.
Mhm.
Okay. It's pulling back into an area. There's an unfilled gap here where buyers will probably show up. And so there's this, the trade-off. If it goes up, you made less. If it goes down, you lowered your cost and they don't take the stock away from you. So what we're really talking about here is how do I get to make an educated decision about selling this covered call to put some money in my pocket? And ideally, I still get to cover or keep my stock. I get to take the money away from somebody willing to buy that call. I get to keep my stock in the best of both worlds. It doesn't collapse. Right? And if it does collapse, I still lowered my cost.
Greg, just one very important clarification. Because you said if it goes up, I lose money.
No,
And
you'd make
what
less.
that's what I want to clarify. The only way you're going to make less is if you take your strike price of $52, you add the $1.62, and so what's that? Is 53.62. So let me type this because it's important. The only way you're going to make less money by doing this is if WPM closes above 53.62 in 8 days. And it doesn't mean you lost money. It just means you're capping your gains at 53.62. So it can still keep going up, and that's fine. You still made money, you still lowered your cost basis. You're just capping your gains at 53.62. Okay, does everyone get that? All right, so here's an example. I remember this old example, but it shows you the beautiful thing. It's a good word, right? Or strategy, beautiful strategy of a stock that you want to hold for longer periods of time. You can sell covered calls against it monthly with the pattern, and you're just consecutively lowering your cost basis. And also keep in mind, even if at expiration it closes above your short strike where the OCC is going to automatically take your stock away because that's what its job is, you can buy it back beforehand. So if you want to keep your stock, you can just buy back the call. All right, so this again, old example, UAL, hypothetical, we bought 1,000 shares, inverse head and shoulder, nothing to the left. And this, I just started the example here, but definitely, you could have sold calls earlier, but let's just go here. So it got crazy extended, came up, rallied to resistance. Do you remember our chart before about the pictures of slowing momentum and when to leg into these? So just follow the math because that's all I want your takeaway to be. 1,000 shares here, 57,230, and that's even without margin. So don't even worry about margin. I sell a 10 lot of the $78 calls. So, just eyeball this. This resistance is $76. Just eyeball it. Don't get weird on me here. So it's $2 higher. That's a little bit arbitrary because I still was happy with the premium. So I took in $1.42 a share, right? Because one contract is 100 shares, so this would be 10 contracts. $1,420 goes right into my brokerage account. It's mine to keep. It's mine to keep. All I have is an obligation to sell 1,000 shares of UAL on or before 28 days to expiration. That's my new cost basis. Okay, it's bobbling around in a trading range. If you were long the stock, you're either flat or down. I'm $1,420 ahead of you. Next example, rallied up. It was bullish price action, but this red bar got rejected. Let's do it again. The same 78 calls. This time I took in $1.90 a share. Adjusted basis, 53,910. This is just in 2 months. I've lowered my cost basis 5.8%. I mean, do you all see the power of this? And we, you know what, Greg? I started to, look for more current examples for this, and I'm like, these are beautiful. I don't need it. But guess what? In our closed trades, Greg, I just did a scan this morning of covered call in our closed trades, and I think it was like 240 hits came up. So my point is, we do this all the time for our subscribers. So Bree is saying, still doing covered calls. I just answered that for you with a great example. We do it all the time. In fact, we had one on NUE. We legged into a covered call just the other day. All right, so that's covered calls. Now let's talk about selling naked puts. Greg, how come so many people, traders, brokerage firms, the media, say selling puts is risky? Can you explain that to me?
Well, as long as anything is risky if you don't know what you're doing, but if you're willing to, sell a naked put and you don't mind owning the stock and you can read a chart where support is, it's a pretty good strategy to put the odds in your favor and buy things cheaper.
You just hit it on the head. Let me jump right to this one. This is why anybody who tells me selling puts is risky, they really don't know what they're talking about. And unless you're talking about people, don't understand the leverage or something like that.
Eric, people go broke buying Apple computer at the wrong price because with a no money management strategy. So it's easy to go broke in the stock market.
Okay, but by definition, selling puts is less risky than buying the stock. Why do I say that with 100% confidence? It's easy. You buy the stock, you buy Apple at 222, and I sell a put at 220. My loss by definition is less than yours. By definition. Let's look at examples. So, again, we define this above, but we're collecting premium in exchange for an obligation to buy the stock or ETF and agreed upon strike price if the put buyer exercises it and wants us to buy it, or auto assignment if it closes 1 penny in the money at expiration. But I have this money to keep. Now at Master Trader, we sell puts the majority of the time as a speculative trade, meaning we're looking at the charts, don't think it's going under there. We sell a put, and our intent is to keep the money, manage in between, trailing stops, etc. If you don't mind owning the underlying stock, this is the most amazing strategy that exists. You sell a put and you know, get it in my course, which strike price do you want, etc. And I see Microsoft's continuing to rip. We sold puts on Microsoft this morning. But you let's look at some examples. It's a win-win. You keep the money as pure profit, the premium, or you own something that you don't mind owning anyway at a cheaper price. Greg, how is that more risky than buying stock? I keep the money, all right, buy something on wholesale price.
Doesn't sound risky to me.
Those are the two scenarios. These are all just beautiful pictures of examples. Now, again, for speculation, let me go back to this. For speculative trades, we do this all the time. This is our weekly options trader. We find compelling patterns, we sell. So this would be selling a naked put. We just sell the put under support where we think it's not going to go by expiration. This is taking some of the money, buying a further out of the money put called a bull put credit spread. Now, whether you do this on something you genuinely don't mind owning, I would just sell it naked. But the benefit of doing a spread is it's less buying power requirement at the brokerage firm. And if you do get a catastrophic gap, you know, it's going to limit your max loss spread with less credit received. And so whatever premium you take in, that's your profit potential. Now, you know, what is a quality stock? So, you know, you decide in your own trading plan how you want to sell these puts. If it's speculation, I don't give two hoots about their fundamentals. I do it on a compelling pattern. You know, we did one on SMCI today. I don't care. Greg says, "Oh, Dan, you know, they got, you know, accounting irregularity problems." I don't care. Look at the chart. We sold a put spread on it. But if you genuinely want to own it, you decide for yourself what definition that means. I mean, I'll do it on anything because that's me. You know, go check us out in our green trading room if you don't know us. I mean, we've been doing these seminars like this on YouTube for over 7 years. We give you great education, but this is where you get to watch Greg and me interact in real time with subscribers, scanning, trading, answering questions. All right, we're almost done, and we'll look at charts here, as we always do in the last few minutes. All right, so what is this? Weekly chart. I don't even know what this is. We do this on purpose because it doesn't matter. It doesn't matter. So it was in an uptrend, 20 MA, consolidating for a couple of months, you know, grinded its way higher. Would I buy this as a directional trade? It's one of these mildly bullish ones. So could you buy the stock and sell a covered call? Yes, because the risk to reward is similar to this. But let's look at the math of this now. So it's a closing breakout, range expansion closing breakout at 215. If we sell these $210 puts, and what is that? You know, you can't talk to me, but I'm going to ask you a quiz anyway. What does selling those 210 puts mean? Well, Dan, you already told us 3 times. It means I take in premium. In this case, I take in $3.50 a share. So if I sell one contract, $350 goes into my bank account, brokerage. 10 contracts, $3,500. As long as it closes above the short strike, I keep that money as full profit. What happens if it closes below 210? Well, I gave you the answer right here. My cost basis, because now, I have one contract. Now I'm required to buy 100 shares. So if I buy 100 shares at 210, I already took in 350. My cost basis is 206.50. Got it. 206.50, Greg, is $9 cheaper than buying it at 215 up here. So again, I got two scenarios. I keep $350 as full profit, or I'm buying the stock $9 cheaper than somebody else. This is an example when these truckers were selling off. Climactic buy setup, here on support, bottoming tail. And so, Greg, we love the term volatility. So when a stock or a sector or the stock market sells off and is in pain and is bearish in the media as the truckers were at this time, the price of these options skyrocket. So Greg, I love doing this to you. Look at this $95 put. You could get $1.45 for selling this put. What did we give subscribers? We shorted the $90 puts, 70 cents a share. This is me, that's my order. And I said, add at $1. If it continues to pull back a little bit, I'll take some more at a higher price. We always give the technical setup, the stock or option trade, etc. So it's a bearish gap, climactic buy setup on support, far out of the money, high premium trade. It moved, it obviously moved up because 4 days later I'm tightening the stop. But here's my Greg, what do you think the odds of this going to $90 are? Now I know you're right. I know you're going to say, well, in 3 days or 30, right? I get it. But isn't, these green lines are showing, as you call it, levels of defense. So
And so the other part is, look, it started moving down from 120. Always the chart and a lot of common sense. Yes, it consolidated at 115, but remember I mentioned this void concept? It collapsed and created a void above. So charts are a reflection of other people's thoughts, beliefs, actions with money. Okay. So this moving down as it has, they're dumping it. Right? We've all been there, right? What did I do? It's collapsing. I got to get out, yada, yada, yada. Eventually, so maybe you've heard the term exhaustion gap, which infers that it's exhausted the supply, right? Or if it's going down, right? Exhaust the supply, which means that it's likely to stabilize. Now, if I can add that concept with another area where institutions and traders bought before called support, the probability is that that particular stock is going to stabilize in that area for some amount of time, which is the unknown. And so trading is about putting together different technical concepts and creating strategies that, that come together at a point in time. And options, the premium, there was enough premium there to make that trade make sense. So as we put together this, you can see how it comes down to common sense. But how do you know common sense until you get any sense whatsoever? Which is called education. So explaining to you what's happening here, where the stock was, how it came down, it accelerated lower, it created a void, it was extended into support. You look at the option table, is there a trade here? Time to expiration, so on and so forth.
All right, perfect. And I just typed out, if you were forced to buy it at 90, well, guess what? Your cost basis is 89. And you could do the math yourself, subtract 89.30 from 103.31 divided by 103.31. And that's the amount you bought this stock on sale. That's the benefit. This was an email. We get thousands of emails, but this is one of our guys here. But it's true. We hear this. I made money and the stock went against me. Now, Greg, if we had an MT live with this title, I'll bet many people would delete it saying these guys are full of shit. But what we've just gone over in 48 minutes, you should see that that's true because of the benefit of this time decay and increased cost basis. And so I'm purposely showing you this one that went against us to illustrate that. So right here, over this green bar, it's a junk little bottoming pattern. We sold the $9.50 puts, breakout from a bottoming pattern at the 2050 MA. We'll take an assignment if needed, I said at the time. So the stock could fall 12.6% after our entry, and we still made full profit, $300. If assigned, our stock basis our cost basis is $920. This is a closed trade. We made our full $300, 5%, and the stock went against us. There you have it. That's the benefit of options. All right, so we're done. Greg put together this beautiful offer for you. Here's a quick link to it, mastertrader.com. Options now. I think Greg's going to post the real one. But this is Greg's swing trading course. We're technical based traders, so this is the one I send everybody to. And the top down course is more the intro to stock and options. It's great, comprehensive. And then we have these other advisory letters included in it. Directional options is buying calls and puts, covered calls like we're talking about today, different scenarios. And then the full course of options is buying, selling. It's everything combined.
B, that link that you asked about, if you were a newbie, it includes this course here.
Right.
Yeah. So, if you were interested in delving all into this education, that course is already included. And with these specials, you get a month of the advisory letter. I'm going to show you one of the layouts, but all the layouts that I have, not all, but some of them are over the top you wouldn't need. But anyway, the most beneficial ones, we share those layouts from TC 2000 with the scans and such in there. And this is for some of you that would want all of it. There it is. So an amazing savings there to do it all. And this one has got 3 months of the letter included. All right. So I had posted a chart of Apple Computer because this makes total sense, Dan, to sell a naked put, especially if you want to own it.
Yeah, I mean, yeah, look at Microsoft today was another one. Amazon was one.
But this one's been going down,
No, right,
right?
right, right. But
Yeah.
this is another great example, Greg, of it's not a directional setup with
Right.
one of those beautiful patterns that we would say, I'm fully bullish on this. And so go
So
ahead.
looking at that, look, this is the 200 period moving average. Every institution in the world is looking at that on Apple Computer. And so you can see that's at about 217-ish, give or take. This is major support in this area here, similar to what you saw on the slide. So there's going to be buyers in this area, 100%. They're going to be down there. It's fallen 15% already. And that doesn't mean it can't go down lower at some point. But again, figure Apple Computer, institutions want it, blah, blah, blah. Go to the option table. This is 9 days. We look to the left. $1.37 by $1.39. You could sell them for $1.38, lowering your cost by $1.38 from where it is right now.
Or
Sell it
no,
naked.
no, Greg, it's not from where it is right now. It's from the lower strike price. So it's better
Yeah.
than where it
Right.
is.
That's where they would put it to you.
Right.
Right. All right. If it went up from here, you just keep the money at the end of the 9 days.
Right.
But so, you wouldn't own it, but you'd put that money in your pocket. Now, if we went out 16 days, and we said, what if I sold the 210? Now you're getting into the void here to be dropping, so if you don't mind owning it, but I don't know if it's going to keep going down. But if you're willing to go out and you say, I don't care, I'm still willing to own it. What if you're willing to own it at $200 and you sold these for 71 cents naked for 16 days? Like, I'll own it at $200, a whole number on another area of major support. You're going to tie up that money, right, for 16 days if you have the money in the account. But seems like a no-brainer, doesn't it, Dan?
Mm-hmm.
Talking and looking at it, you got this pivot down here, the support, $200. And the probability of going down there, I think, is from this point, since it's already fallen 15%, is relatively low. All right. What else are we going to look at? Robert saying he sold the 215 for the next expiration.
Sure.
With support.
Absolutely. Yeah,
At a major support level.
yeah.
So,
I mean, I'll wait into the close and then I'll sell the 220s for Friday. Right now they're at a dollar.
okay.
And
So technology is hot today.
pull up Microsoft. We sold puts on that today. Is an igniting gap. And if I saw it earlier in the day, I would have bought it too. But we sold a put spread on that for Friday.
Yeah. So what strike did you sell, Dan?
I just sent an adjustment here. We sold the 435, 430 for 60 cents for Friday. We're already at 50%.
Hi, Ian, and you have my username in TC2000. So just send me a message and I'll send you. All right. So Microsoft tech, I was going to say technology is hot, right? Today. It's up at resistance. So you can go here and sort this by percent change on the day. What is up the most? right? Seagate. This could be selling a credit spread, which isn't today's subject, but if you owned this stock, it would make sense to say, hey, doesn't it make sense for me to sell a covered call that
Yeah.
it gapped up? And it's probably the options were higher this morning, but let's say 114, probably 115. I got this sorted by volume. Uh,
I had this on a
these are
very, go
these
ahead.
collapsed, you know. Yesterday they were 45 cents, of course. So, but you'd have to go out further out and see. This is the factory work. Is look, there's no premium in these calls, even going out for 9 days. Go so you look down at $115, and it's only 35 cents. It isn't much. No, you
I'd
could
rather,
sell them for 40 cents.
but I'd rather just sell the stock then instead of sit through the pullback.
Well, right. It would make sense to think it's going to pull back. It could just chop sideways. We don't know what it's going to do. But look, we're talking about strategies here. Like here's one that accelerated higher. And so you'd want to look at the higher time frame. It's at new all-time highs. And maybe it'll keep going up. Um, Dell. I mean, it was up. Now it's a topping tail. You can see it's been sold off. But you do the same thing. It'd be like, okay, maybe that's a bottom. And again, if you're interested in option strategies, which is our thing today, and say, okay, you know, down here, would I mind owning this? I wouldn't want to own it, but I would just it could be something where you'd want, again, another subject could be an iron condor. Yeah, now that it's made this support and this resistance, it might just hang out here.
You're,
Um,
you're
but
getting,
if I want to find things that are extended, I could sort it by that indicator. Well, that's going to be the highest things. Another way of looking for that. I could go to a different scan. If I go and look at S&P stocks, which I would just click here, spiders, and sort that. Now, there's an example of something I'd want to sell a covered call on.
without
If
a
I,
doubt,
it's,
perfect.
it's extended. Now I just slide this over and go look at call options. It
Yep.
only has monthlies, so you'd have to go out 30 days. So I just go to 169. I go look above that,
Mhm.
170, 180. So it's a month to expiration, 180. So at $180, if you could sell this for $1.50, lower your cost. Say you bought it here, you'd lower your cost by that $1.50.
Mhm.
And if it went up to 180, they're going to take it away from you at 180. It had to go beyond $180. That
Yeah,
just seems like a pretty good deal
I agree.
for 30 days.
I mean, I would even do the 175s, but again, we talk about it in the course and we look at the risk graph, which one's better, and it depends on what the stock's going to do, of which one's going to pay you more at the end of the month.
Right. So this is one of the layouts. And again, part of including options, a top-down approach, S&P sectors. These are all ETFs that we like to focus on. When you click this or financials, it loads the stocks within there. You could see the options, could change time frames. And this is a nice layout too that we share. None top-down approach, sectors, subsectors, sectors within there. And again, you click on one of these and it loads the stocks in there and there's scans within here. So high volume strike on arms had a bullish wide range bar, a weekly wide range bar. There's a big volume spike. Maybe selling, covered calls if you owned it,
Mhm.
uh,
So
multiple time frames. You can adjust these things how you like, but yeah, so I hope you enjoyed this. Dan, I really thought this was one of the better options. MT Lives. I mean, it seemed less, I like to use the word brain damage, but the way you
I,
explained it, we went through it, I thought it was pretty good.
I was more conversational, yeah.
Yeah,
It's
yeah, it was good. So yeah, take advantage if you have questions. That's a awesome, offer for both of the courses. And if you have questions, email Dan and I, and we'll be back next week. Bye bye.
Thank you for listening to Master Trader Live. If you liked the show, we invite you to share this video on your timeline or tag a friend who wants to learn stock market tips. Stay educated with our free chart of the week, a weekly analysis or lesson sent right to your inbox. We're live every week, and you can subscribe to the channel and press the bell to get alerts. If you've enjoyed the event, please give us a thumbs up. Just visit mastertrader.com. That's mastertrader.com.